Hey everyone, welcome back to Advanced Accounting. In last class, we talked about how to do consolidation when the parent has less than 100% ownership of the subsidiary. And starting from today's class, we're going to talk about intra-entity transactions. So first, let's look at the major forms of intra-entity transfer. With regard to intra-entity transfer, there are two major kinds. One is intra-entity asset transfer, which is covered in Chapter 5 of your textbook. And the other major kind is intra-entity debt transfer, which is covered in Chapter 6 of your textbook. And with regard to intra-entity asset transfer, there are three major kinds of intra-entity asset transfer. The first is intra-entity inventory transfer, which is basically the parent may buy or sell inventory either from or to its subsidiaries. And then the second major kind is intra-entity land transfer, which is basically the parent can either buy or sell land from or to its subsidiary. The last kind is intra-entity depreciable asset transfer, such as machine. So all of those depreciable assets, and the parent may sell or buy those from its subsidiary. With regard to intra-entity debt transfer, we're going to talk about it later when we get there. So before we start to talk in detail about intra-entity asset transfer, here's a question for you to think about. So when we prepare consolidated financial statement, if there's any cases of intra-entity transfer between the parent and its subsidiary, what we do is we need to eliminate the effect of intra-entity transfers. And then the question is, why do we need to do that? Please take 5 minutes, think about this question, and you can pause your video for now. So in preparing consolidated financial statement, if there's any case of intra-entity transfer, we need to eliminate it. And why? So the reason is basically, can you recognize any sales or profit if you are just buying or selling to yourself? So if you are just doing transaction from within yourself, do you think you can recognize anything? The answer is no. So because the consolidated statement should reflect only transactions with outside parties, and intra-entity transfer does not create any transaction with outside party. That's why we need to eliminate those. We have a parent and we have a subsidiary. When we do the consolidation, even though the parent and subsidiary each do recording on its own because they are separate legal entities, but when we do consolidation, we need to view those two firms as one firm. So any transaction within those two firms, they're just viewed as transaction within itself. So that's why we need to eliminate any of those transactions. Because from an outside investor's point of view, those transactions doesn't mean anything. So we need to eliminate those. And then how to eliminate the effect of intra-entity transfer in the consolidation process. So we just talked about, for intra-entity asset transfer, we have intra-entity inventory transfer, land transfer, and depreciable asset transfer. And we also have intra-entity debt transfer. I'm just going to give you an overview here, and then we're going to talk about it in the next few classes. So the consolidation entry to eliminate intra-entity inventory transfer, we have 3 consolidation entries: consolidation entry TI, consolidation entry G, and consolidation entry star G. To eliminate intra-entity land transfer, we have 2 consolidation entries: consolidation entry TL and consolidation entry star GL. To eliminate intra-entity depreciable asset transfer, we have 3 consolidation entries: consolidation entry TA, consolidation entry ED, and consolidation entry star TA. And lastly, to eliminate intra-entity debt transfer, we have consolidation entry B and star B. So we are going to, starting from today's class, we are going to talk about each of those consolidation entry in detail. And then we're also going to go through some specific examples.